Good morning and welcome to the Homestead CPA. My name is Dan Snyder. For those of you who've been with us on this little journey, welcome back. If you've never been here before, welcome. This is part 13 in a 15-part video series about accounting, tax, and legal issues for homesteaders. Today in part 13, we're going to be talking about retirement planning. Now, I know a lot of you are thinking, holy cow, Dan, we're just now getting started in this. What do you mean retirement? Well, not so much retirement in the sense of you're going to sell your homestead or pass it down to your children. That actually will be the next video when we talk about succession planning and estate planning. But I'm talking about making sure that you have sufficient money when you do retire so that you've got money to live on. As an employee, when you have wages, Social Security is withheld, both half from you and half from your employer. And in addition, you may be able to make a contribution to a company 401k plan or to an IRA if your employer doesn't have any sort of company benefit plan. But what do you do when you're a self-employed homesteader? Well, you have pretty much the same options. You could have an IRA or you can have a self-employed 401k for your business. Either one of those can come in one of two flavors. It can be either taxable or it can be non-taxable in the form of a Roth IRA or a Roth 401k. So you have similar flexibility that you do as an employee. And the reality is that you actually have greater flexibility because you're not limited to just one plan. Now, can you make contributions to both a 401k and an IRA? Potentially, if your income is below the threshold. But more importantly, what I'm talking about is the fact that each year you can plan, do I want contributions to go to a taxable plan, such as a taxable IRA, a regular IRA, or regular 401k, or because of circumstances, might I want to make contributions to a Roth version of the same thing? You can have all of those. You could have a Roth IRA, a taxable IRA, a Roth 401k, a taxable 401k. Now, you're only going to use those if you get to the point where you actually need it. So, what do we do? Well, when you're a homesteader, if you're making a profit, which is what we've been talking about, being in business to make a profit, if you've made a profit, that is going to be considered, to the extent that you pay self-employment tax on it, on those incomes that you make, is going to be earned income for purposes of making a retirement plan contribution. The contribution maximums are the same as they are if you're an employee. Currently $7,000 for a tax deductible or a Roth IRA and $24,000 for a 401k total contributions. Now remember, if you have a 401k plan, you can contribute more because you're contributing both the employer's side, because you are your employer, and also the employee's side. It's important to note that timing can be different. So what do I mean by that? Well, typically when you have an IRA, either a Roth or a regular IRA, those contributions can be made up until April 15th of the year following the year in which you are earning your income. So for 2024, the income that you earned last year, you have up until April 15th of 2025 to decide how much you want to contribute to an IRA. And if it's a regular IRA, get a tax deduction for last year. It's one of the few things that you can do this way where you have the ability to pay something because, as we've mentioned in previous videos, as an individual, you're on a cash basis, and normally you only get a tax deduction in the year in which you make a payment. This is an exception to that, and it can be a very powerful exception. Now, you can get an extension of time to file your return and to make the payment, but typically you're going to want to try and figure out what it is that you can and want to make in terms of a contribution to your plan so that you can then start working on the next year. Now, a 401k, on the other hand, because there's different types of 401k plans, some of them have similar realities in terms of timing. In other words, yes, the employee's side of the contribution can be made up until April 15th or as extended, but depending upon the type of plan you have, the employer's portion of that 401k contribution may have to be made by December the 31st, in which case you need to be working with your tax advisor much earlier than perhaps you normally would to ensure that you get to have both of those contributions and both sets of tax deductions to reduce your income. Now remember, these, to the extent that these are tax deductible contributions, they reduce your income for income tax purposes, but they do not reduce your income for self-employment tax purposes. We talked in previous videos about the possibility of using, for example, a subchapter S corporation to minimize your self-employment taxes to free some cash up to enable you to make contributions to a retirement plan. So all of these things tie in together at this point in time. Now, which one's best? That's the question I get all the time. Should I have a Roth or should I have a regular? And like all good answers, it depends. And this is why you really want to speak to your advisor once he's got all of your information for the calendar year in question, so he can tell you, well, here's the effect of making a taxable contribution versus here's the effect of making a Roth contribution. If you are a younger person and you're not paying any income tax, then it may not be worthwhile, or maybe in the 10% bracket, you may be better off making a contribution to a Roth plan. But if you're an older individual and or you're making significant money and you're in a 22, 24, 30% tax bracket, maybe because of outside earnings besides what you're doing in your homestead, then it may make more sense to make a contribution to a taxable plan. And the reality is every year is different. And so you may have a year in which you got a really big bonus at your day job, and so you want to make a taxable contributions where you get a tax deduction for it in that year. The next year, you may not get a big bonus, or you may have gone full-time to homesteading and don't really have a whole lot of income. In fact, you may just barely have $7,000 of income. Well, it may make more sense in that situation to go ahead and put it into a Roth IRA because you're not losing any tax benefits. You're only gaining tax benefits. So these issues are why it's helpful to have a good tax advisor. And you may also recall from a previous video, we talked about other choices that you get to make when filing your tax return. And the big one being depreciation, and whether you're going to make an election to maybe write off an asset, take bonus depreciation, 179, some sort of accelerated depreciation, what's the impact of that with you making a regular taxable contribution to your retirement plan versus a Roth contribution to your retirement plan. So that these combination of factors are what lead me to suggest to you that you work with someone who has the ability to help advise you in these areas. Because as I've told my much older children now, when we were younger, our biggest concern was making sure that there was enough money for retirement. In addition to retirement, in 20 or 30 years from now, people are going to be concerned about having money for health care, as well as long-term disability costs, as well as their actual retirement living costs. And Social Security may still be there. It may not be as strong a benefit as it has been in the past, or it may not be there at all. And so planning for this now can help ensure that when you do want to retire, you're not perhaps forced to sell the family farm because you don't have sufficient money to live on. So these are things to think about now. Even though you may not be ready for retirement, some of you may already be retired, and you may think, well, what benefit would there be for me to put money into a retirement plan? Well, if you're making money, that's always a way to either get a deferral on the tax benefit by taking a tax deduction now, or having a buildup in the value of some of those assets until you actually start taking the money out for retirement. So I hope this has been of help. Thank you very much for being with us today. And as always, remember, even Jesus paid taxes.